We have a question for you for this week. So we've talked a little bit about mortgage insurance in the past, but what are the best strategies for not having to worry about mortgage insurance even without putting down 20%? Or do you always have to put down 20% in order to avoid that mortgage?
Any ways to avoid it without that big down payment?
Yeah.
Yes, so let's talk about that. So first, I just want to talk about what is the mortgage insurance? And the mortgage insurance is insurance that protects lender in case the buyer's in default. It does not insure the buyer. Basically, the philosophy behind that, when you put the least money you put down, the higher chance of you defaulting on the mortgage, and that could be very costly to banks. They have to pay litigation fees, attorneys fees, realtors fees. So they want to be protected. And on conventional loans, when the down payment is less than 20% down, the mortgage insurance is required. However, it is removable once a client reaches 20% equity. They could request removal of the mortgage insurance. Once they reach 22% equity, the mortgage insurance payment goes away on its own.
Okay.
And the mortgage insurance payment on conventional loan depends, it varies depending on the credit score. The higher score, the lower insurance premium, which is logical, right? So the lower credit score, there's more risk to the insurance companies, so, and to the lenders, so the mortgage insurance premium is going to be higher.
Yep.
Also, a down payment percentage plays the role in the monthly mortgage insurance, and number of borrowers. When there are two borrowers versus one borrower, the mortgage insurance will be lower because more people on a loan, lower risk for them on defaulting because we're using two incomes.
Right. Okay.
Yeah, but that's conventional. On FHA, it's a little bit different. The mortgage insurance is there regardless of the down payment. Even if the down payment is 20% or 50%, you're going to have a mortgage insurance.
Okay.
If the down payment is below than 10%, mortgage insurance is not removable unless buyer refinance to conventional loan later. But if the down payment is 10% or more, then it is removable, but they have to pay it for at least 11 years. So it's one little thing.
Okay.
Positive aspect of FHA insurance is that the premium is fixed. It does not fluctuate depending on the credit score.
Okay.
So if your score is 600 or 800, you're going to have the same mortgage insurance on FHA loans.
Okay.
Yeah, so sometimes when I qualify a person and I see that their credit score is below 700, in a lot of cases, it's better for them to go with FHA because the mortgage insurance is lower than on conventional, because on conventional, it bumps up once the score is below 700.
Okay. And then the other thing I find interesting about the differences there is with the FHA loans, at best, they're paying for it for 11 years. Like, unless they refinance. In conventional, it's like you can request removal once your equity is 20%, and that doesn't just have to come from what you've paid into it. That can also come because the property values have increased so much.
Yep.
So I really love that. I know our Niceville house in Florida, I think we got out of it within, I think we put 10% down. So we had mortgage insurance, but then we got out of it. We were at 20% within a year and a half.
Yeah.
And I was like, oh yay, that was really, really cool.
Yep.
It is a good point. Yeah. So the bank calculates when you reach 20% equity based just on the sales price versus your balance. We don't take into account the appreciation. However, if you know, you feel like, your property appreciated and now you have 20% equity, you contact the bank and you tell them that, and they would order appraisal just to confirm, and they will remove that mortgage insurance.
Yeah, that's right.
Also, it is good to know for those who know that they're going to maybe they're expecting inheritance or they're selling a home, they didn't know they're gonna put a chunk of money into principal soon. And once they reach that 20% equity or 22, it will come off automatically, or with
Yeah.
20 they'll request it.
Okay.
Yep.
Very
Yeah,
good.
I like it. Okay,
All
so
right, so
now
now
let's talk about how to get out of it.
the magic.
The magic is with conventional loans. We do have ways of avoiding mortgage insurance. Just want to give you an example. And when I qualify clients, I show them those options so they know what options they have and that they make that educated decision. So let's say we have a sales price of 400,000 and somebody's putting 10% down. So they have 740 credit score, first time home buyer. Some of these factors do play a role in the mortgage insurance payment. And it's just not a first time buyer, but it's in not only first time home buyer in this example, but also just one person on the mortgage. So let's see option with monthly mortgage insurance, just regular one. I ran numbers yesterday for this scenario, 7% interest rate. Mortgage insurance is $72. My computer estimates that if the buyer pays as asked, they will reach 22% equity in 115 months. And
Okay.
that's when insurance will come off. And in 115 months, they will pay around $8,280 total into the mortgage insurance. The principal and interest and mortgage insurance payment is $24.67 per month.
Okay.
There's one option how to avoid monthly mortgage insurance, and it's called LPMI, which stands for Lender Paid Mortgage Insurance.
Okay.
What it does, it actually eliminates monthly mortgage insurance by increasing the interest rate.
Mm.
So the rate is 8% versus 7%. There's no mortgage insurance and the payment is higher. So obviously this option is not very good option as of right now. And I remember, and I've been in business for over 20 years, but I remember times when this was very popular option because the difference in the rate was only an eighth or a quarter. So, and the mortgage insurance at that time was higher. They actually reduced the mortgage insurance premiums now. So mortgage insurance still has a bad name, but it's not as bad as it used to be.
Okay.
So in this particular example, LPMI doesn't really have a good, you know, option. It's
Not a
not a
good
good
option,
option.
yeah.
It's not a good idea. So the third option that is most popular right now, it's mortgage insurance paid upfront as a premium. So it is a one-time premium of $38.52 in this example.
Okay.
And that premium can be paid in cash at the settlement. So the settlement cost increases by $38.52, or they actually can finance this amount into the loan.
Wow.
Oh, wow.
Which, you know, we know that the mortgage insurance is not always tax deductible, and you know, we are not accountants or tax people, so check with your accountant.
Yeah.
If in your case mortgage insurance will be tax deductible. It is tax deductible, but not for everyone, so double check on that. But once, if you pay it as a premium, it becomes the interest if it's financed into the loan. So, and the interest is tax deductible. Again, double check with your accountant, but that's what's widely known. So mortgage
Right.
insurance, yeah.
Can I ask you real quick? So on that, that premium, if it's put into the loan, let's say the house, the sales price is 400,000 and the house sold for or appraised at 400,000. Would this be a something they'd have to come out of pocket if does it have to appraise for that amount basically?
Like, would it have to appraise for 403,852?
Yeah.
No, so no, not necessarily. So basically, it means that the loan amount is not going to be 360. It's going to be 363,852.
Or yeah, okay.
Okay,
Yeah,
gotcha.
so that's what it means.
Okay,
And adding it as a premium to the mortgage is not always available. Let's say someone's putting only 5% down, and they might not be able to add it because then their loan to value is going to be over 95, and it's not available for in all cases. So that, but we're going too deep into this. So
Yeah.
it's possible to add it to the loan amount, or you can pay it in cash. Just let's leave it at that. And if somebody is interested to know more, they always can call me.
Yeah,
okay, gotcha.
Yeah.
I love
gotcha.
that option. I love it.
Yeah. So the mortgage insurance premium is paid up front, and we can see here that it's much lower than paying it
Yeah,
over the 115 months.
Yeah,
There's no monthly MI, and principal and interest is $23.95.
woohoo.
yeah, I like that.
It is $72 lower, and actually, basically, you are prepaying that mortgage insurance for 53 months.
Yeah,
You just
Gotcha.
pay the whole mortgage insurance instead of 115 months, you're paying it in 53 months.
Okay,
Great option. Again, might not be for everyone. Like I mentioned before, if somebody knows that they're gonna get a bonus or inheritance or selling a home, they might just stay with the mortgage insurance. But for those who think they're gonna be in, they're not planning on paying extra, they're not gonna be refinancing, they're not gonna be selling anytime soon, and the monthly payment, lower monthly payment is very important
Yeah.
for them. That's the option to go.
yeah.
okay. Very
Yeah,
good.
so that's my 2 cents to the
I like
topic.
Well, that's a good 2 cents.
Yeah.
It's good for people to know, because a lot of people, like you said, mortgage insurance has a bad name, so a lot of people are
Yeah,
sitting at home saving up that extra 10% in order to avoid that $72 per month, and meanwhile, prices are still going up, and they're
yeah,
they're missing out on a lot of appreciation because they're trying to simply avoid that.
yeah. It's a lot harder
that-
to come up, save up another 40,000 than it is that upfront for what, 30, less than $4,000?
yeah.
So,
Yeah, good options. Okay.
yeah, woohoo.
Yay, thank you.
You're welcome.
All right. Oh, so if anybody needs to talk to you about these strategies and options, how do they get in touch with you? Do you have your slide?
Yeah, show it.
Ah, I forgot it.
Oh, no.
That's okay. It's a lovely slide.
Yes, yes. Okay, so how do they get in touch with you?
Next time I'll put it on for sure.
Okay.
But my number is 571-245-3000.
All
Yeah,
right, awesome. Well, thank you, and have a happy Easter, and we will see you next week.
yeah.
Happy Easter, guys. See you
All
soon.
right.
Bye.
Bye.